Got a special guest in the room today. Hello. I'll pull up a chair if you want. Okay. Who wants to tell me what they're grateful for? Kathy, what are you grateful
My
for?
coffee.
Here,
I'm grateful for my coffee, my second cup today.
this is also mine.
So the whole team will be going, tell her to calm down if I do 3.
All right. Let's see. Kathy, what are you grateful for?
I submitted my offer.
Beautiful. Beautiful. Great job. Thanks for coming in yesterday and confirming all the things to make sure that you were, playing your role as best as possible. Great job there.
Appreciate it.
Melissa, what are you grateful for today?
To be honest, Bella, I'm grateful for sleeping in today.
Okay. Well, I appreciate you being here. For sleeping in for some people is, 7 o'clock, and sleeping in for some people is, 7 o'clock at night, right? So thanks for being here today.
Sure.
Nadine, what are you grateful for today?
Good morning, everyone. I am grateful for the opportunity to learn some more and to help more people, and I'm super excited about it.
Beautiful. Thank you for being here. Brian, man, I love that picture, by the way.
I do too.
That is hilarious. That's really you, isn't it?
That is really me.
Yes.
Oh,
That is hilarious. All right, sir, what are you grateful for today?
I'm grateful for my teeny tiny little Valentine.
Oh, I love that. I love that. Jenny, how about you?
I'm grateful for a really nice Valentine's weekend. So
All right. Markia.
Good morning, Bill.
Good
I'm
morning.
grateful to be featured on the team meeting today at 11, so I'm excited.
All right, just so everyone knows, Markia has been on a bit of a journey over the last couple of years. And as of a couple of weeks ago, as we know from celebrating at the place at the Avalon recently, is now full-time in real estate. And that's a big deal. And it came from a whole lot of desire, and probably most importantly, consistency, right? Showing up. You probably have near perfect attendance at the morning huddles, near perfect attendance at our weekly coaching sessions. I mean, this was a commitment in every way, and you deserve every bit of your accomplishments. And I'm just excited to have been able to witness it all. So great job.
Thank you, Bill.
Everyone tune in today, and you can hear a little bit more about her story and her journey, and all of what's to come for you. So awesome job. Awesome. Okay, who are we missing? Lorinda.
I'm grateful to wake up on time to be here at the team hub.
All right. Tracy.
Good morning. I'm grateful to be on this call to learn about underwriting.
All right. Nothing like tuning into an 8:30 session on underwriting. Huh?
My husband has a saying. He says, "Stab me in the leg, it'll be a lot less pain."
Yeah. Yeah. Tomorrow, what kind of topic can we cover tomorrow?
That would put everybody back to sleep. What do you
Right.
think?
Exactly.
Don't make me sleep in again, Bill.
What's that?
Don't make me sleep in again.
Yeah, I know. Okay, Alex, you're up. Make sure you're not too boring today, okay? Okay, who's Galaxy Note 8? What are you grateful for today? All right, we'll come back. Candace, what are you grateful for?
I'm grateful for my sweet husband. Every day is Valentine's Day with him.
Oh,
I know, right?
How about you, Ann?
I am grateful to be here. I'm excited meeting all of you. So that's a treat today.
Awesome. I'll tell you what I'm grateful for. I feel like after, God, what has it been? Like almost 9 months of working with a personal trainer. I feel like I had a bit of a breakthrough last night. Like I was like much more energetic than normal. I was able to do more than I'm normally able to do. So like, I feel real good today for the moment. I'm sure I'll be in a lot of pain later, but I feel real good.
I can teach you how to drive with your elbows.
Yeah.
Epsom, Epsom salt baths is your friend.
Yes, I tried the like, I'm in a lot of pain, I'm going to sit on the couch thing, and that didn't work so well. So yeah, again, it's just another piece of evidence that consistency and desire and not stopping, you'll get what you want, right? Alec, did you answer yet?
No, not yet.
All right, you're up, sir.
I think Melissa and I are on the same page. I got my 8 hours last night, which is rare these days and was greatly needed. So feeling good this morning.
Beautiful. And Terry, you're up. Last one. All right, we'll come back. Oh, there you go.
Oh, what am I grateful for?
That's right.
The chance to get 1% better.
I love that. Love that. Thank you for sharing. Okay. Without further ado, I want to give the floor to Alec Jones. He is a team member with Kathy and the others to help provide, mortgage services and mortgage information to you guys. At the end of the day, it's all about, at least in my opinion, it's all about being a resource for information for your clients, right? We don't make the decisions for them. We help gather the information they need, present it to them in a clear way, explain to them pros, cons, good, bad, etc., and then allow them to make the decision that's going to make the most sense. Alec, why don't you give us like a tiny bit of your history, if you don't mind, and then let's jump right in. And while you're doing that, I will give you permission to share your screen. Okay.
Perfect. Sounds good. Thanks, Bill. Yeah. So my name is Alec Jones. Looking through who's online, I think I've met most of you guys. But yeah, so I came right out of school, went to Berry College, graduated in 2019, came right out of school and jumped into the mortgage world. Started out as a loan officer assistant for Kathy, and then for another one of our teams up at the Alpharetta office. And then I've just kind of worked my way up to the loan officer position. I've been doing that since probably, last we'll say July. And so I've just kind of been growing in that and getting to meet all the agents and all you guys and just really enjoying it. So just grateful to be part of the Roswell office. And so yeah, that's right out of school jumping into it. So I jumped in at a pretty crazy time. And so it was I say normal, it was ramping up. It was already a pretty competitive, crazy market when I came in July 2019. And then COVID hit, and it just has been chaos since. So really,
I was thinking, I don't know, maybe you could answer this too, but in over 16 years of being in the business, I don't think I've ever been in a normal market. It's always some type of anomaly.
Sure.
Right. It's always a super strong buyer's market or super strong seller's market or foreclosures everywhere. There's always some type of challenge that we have to be navigating. And, so awesome. Okay. You now have permission to share your screen. Tell us what we should know about underwriting, sir.
Yeah. So what we're going to do this morning is we're going to go through a desktop underwriting findings. So what that is, and let me get it pulled up. And can you guys see that?
Yes.
Perfect. So what we're going to do is, there's two, when we think of underwriting, from a loan officer perspective and for what you guys need to know, we think of two different things. So the first is the loan officer during the pre-approval is running automated underwriting, which is this what you guys are looking at right now. We're doing that on the front end because essentially, if we get this approve eligible, which you're seeing here at the top next to the recommendation, that tells us if we have and validate all of the information on the loan application and are able to validate anything that DU tells us we need, then we basically know that that's going to be a good loan. And so on the front end,
Yeah, exactly.
on the front end, what we're doing is we're running the system and we're reading through what we're gonna go through this, and we're gonna make sure that we have everything specified in the findings. And so DU is the underwriting findings for Fannie Mae. Loan product advisor is for Freddie Mac, both conventional loans. For FHA, we can run either. And then for a jumbo loan, we use something called loan scorecard. And they're all doing the same thing. They look a little bit different, but it's basically comparing all of the information in the application to the Fannie Mae, Freddie Mac, FHA guidelines, and kind of cross-referencing and making sure that everything looks good. And so
let me ask you a quick question, Alec, before we go on. I want to make sure we've got a lot of newer agents on the call. So why is it so important to underwrite these loans to other people's standards or other organizational standards?
Sure. Yeah. So at the end of the day, once once the loan closes, it's being sold in the secondary market to Fannie Mae, to Freddie Mac. And so if they are not meeting the criteria set by these investors, then these loans are unable to be purchased. And they have to be held by shelter, held on the books, which is not necessarily what is needed. So we have to make sure that each loan meets that criteria for whether it's Fannie Mae, Freddie Mac, FHA, whoever it might be, so that after the loan closes, it can then be sold and be a solid loan.
Thank you.
Kathy, do you have anything to add to that?
No, it's basically like Alex said, if we don't go by the guidelines, if the underwriter doesn't satisfy the findings, no matter, especially on a jumbo loan, our company's going to buy that back. When you say buy it back, they'll be servicing that loan for the 30-year mortgage. It's a very, very big loss to the company. So it's extremely important that the underwriter, and there is some leeway. We're very fortunate to have local underwriters to interpret things that may not be exact black and white rules. There are little gray areas that we can go to, but 99% of it, and you're going to see it as Alec goes through this, we have to validate everything. The application goes in, it's called the 1003. We critique it, where do they work? How much money do they have in the bank? Have we looked at those bank statements? How much income have we calculated? And then this system reads all that, and he'll go over more and tells us, yeah, if all of this is true, if you can get a bank statement, a pay stub, a W-2, what we're asking for, then yes, this loan is sellable, do the loan.
Yeah. Perfect. So what we'll do is we'll kind of just go line by line here and look through. And so every loan is a little bit different. There's rarely two loans that are exactly the same. So these findings are, we're going to look at some of them. There's a ton of different options and things that DU or LPA might flag or want us to get a little bit more information on or more documentation.
LPA.
Do what?
What is LPA?
Loan product advisor. It's DU, but for a Freddie Mac. So Freddie Mac has LPA, Fannie Mae has DU. Yeah.
Okay, and DU is desktop underwriting. So basically it's the secondary market buyer is dictating the standards to which the front end loan is going to be processed or critiqued, if you will.
Correct.
Right.
Yep.
And there are differences, big differences, and we'll run both, and it may eliminate something that's a problem for one. Fannie Mae may want certain criteria that Freddie Mac doesn't, especially when it comes to condos. So we'll run both and see if we can eliminate any paperwork at all for the buyer.
Yeah, and I had one recently where, so DU, the debt to income ratios, it actually keeps them, to 2 decimal points, where LPA will round up to the next full point. And on those ratios, when you're in the 43, 44, 45 range, that 0.4 really can make a difference. So yeah, we're running both because there are a lot of similarities between DU and LPA, but there are some differences. So we are running both.
Yeah, sometimes it's so close that we get with the insurance agent and say, look, right now we need their deductible higher. We've got to get this down by, a couple $100 a year on insurance. And then after closing, if they want to change it and get the lower deductible and go up, they can. But to closing, we've got to have that lower insurance premium.
All right, y'all be looking really closely because I see a couple what I would consider to be oddities so far. So take note of what you're looking at, and we'll come back to that stuff.
All right, so I picked one of our files that had a little bit of it wasn't just black and white W-2 salary bar, where it was someone with a little bit more detailed credit history. So we'll see that as we go through. So the first, whoops, zooming in here a little too far.
Is that a word?
So the mortgage information, it's just what it's doing is it's looking through, it's pulling in and reading how we have it set up. So these are, more or less on the closing cost worksheet, that first box yesterday was the loan parameters. That's what this is. So it's got our loan to value, our debt to income ratios. It has our interest rate. And so on the ratios, just to point this out, you have your housing expense ratio and your debt to income ratio. So what that is, your housing expense ratio is just the debt associated with the property you're buying. And then the debt to income ratio is all other debt included. So if you have student loans, if you had credit cards, if you have a car payment, it's going to be all of that plus the new proposed house payment, principal, interest, taxes, insurance, and HOA if there is any.
Okay, so one is called oftentimes called a front end ratio, and the other is back end ratio, right? So what we see here is you got 42.5 and basically 44.5. So what does that tell you about the person's credit stuff? Who wants to shout out an answer? They don't have a lot of debt. They don't have a lot of reoccurring debt, right? Because the debt that they would be taking on from their house payment is very, very close. It's only 2% off from their total debt. So this shows me they probably have maybe like a little car note, probably not even that, maybe a little credit card balance that they happen to be carrying, right?
Yeah.
This person has very little debt.
Yeah, so, and this calculation is based off of their gross monthly income. So that tells you that their back end debt to income ratio, only 2% of their total gross income goes towards reoccurring payments. And in their case, it's 2 credit cards where we're only calculating the minimum payment. So yeah, they have very little reoccurring debt. Most of their income is going to be eaten up by this proposed, the house that they're looking at buying.
It also looks like they got, they're basically putting down $225,000, and the debt that they're going to incur from a loan of roughly $222,000 is almost half of their income.
Mm-hmm.
So they got some cash from somewhere. Maybe they won the lottery or something.
Yeah, good at saving. That's what it seems like. So, and maybe they won the lottery. Let's see. Okay, so this section here, the risk eligibility, it's going through, and a lot of this is just it's general messages that we get on pretty much all of these loans. And so right out of the gate, it says the risk profile, appears to meet Fannie Mae guidelines. And it's going to let us know, it's just going to, flag. So Home Ready is a first-time home buyer program, and it's income cap. So there are income limits on it. So what it's doing, this is, I'm on 3 here. What it's doing is it's looking at the income that we've calculated that's in there currently, and it's saying, hey, based on their income and because they're a first-time home buyer, they are potentially eligible for this Home Ready program. And that's just, that's for us to make a note of. Line 4 is always going to be in there as long as COVID's around. And then line 5 here. So what DU does is we have to pull credit in all of our files. DU is cross-referencing the credit profile, not only the credit scores, but the credit profile. And I was going to pull a credit report up for you guys to kind of look at as well. But unfortunately, how it's encrypted, because it is personal information, it didn't allow me to redact any of that. So I wasn't able to grab it. But it scanned through the credit report. It noticed that there was a non-chapter 13, and in their case, a chapter 7 bankruptcy. And so it's going to tell us, hey, if this is what's going on, this is what's going to be needed. So it's saying a non-chapter 13 bankruptcy has been identified. If it has been discharged or dismissed, and we've been 4 or more years since it's been dismissed on the credit report, then we don't need, then all we need is those discharged documents that the credit, that the bankruptcy has been discharged, and it's been 4 or more years since that's happened. And so you see it, and then it gives you the date filed versus the date satisfied. We're going to get those documents and make sure that it has been the 4 years since it's been discharged to do a Fannie Mae conventional loan. FHA for Chapter 7 is going to be 2 years. So in this case, it was discharged in 2015. We got the documents that verified that, and we're able to move forward with the conventional loan.
If you guys have questions along the way, just type them in, and we'll come back to all the questions once Alec is done.
Yep, absolutely. And then it's going to tell us, hey, here are some strong factors, some strengths in this borrower's loan application. And because this, because of the bankruptcy and the credit scores being a little bit lower, it's saying that, hey, because you're putting, she's putting the 50% down, that loan to value, the more you put down, typically the stronger, that's going to be a strength in the eyes of these investors. So putting 50% down is going to be definitely a plus.
And that's also probably something that might, for example, cause the appraisal not to be necessary, right?
Yeah, and we'll look at that as well.
Okay.
So here are just some verification messages. So we're able to pull the work number if a borrower, if their employer is even on the work number. So a big company, one that we see a ton, Equifax, or if they work for Walmart, Home Depot, companies like that, they're going to be on the work number. And what that means is we can pull that work number in. And if they have been there for 2 or more years, we can actually not have to request income documents from the borrowers. It will compare the work number versus the income we have inputted. And if they match up, then it'll just give us the thumbs up. We don't need to ask for W-2s, pay stubs, all of those documents. If it validates it, this borrower didn't, her company wasn't on the work number, so we weren't able to pull it. So then it's going to say, line 9 it's looking at the credit report. When it's good for, it's good for 4 months from the date that we pull it. So it's just letting us know, when those things expire. And so what we're doing, like I mentioned, there's kind of 2 steps of underwriting here. The first one is we're pulling this automated underwriting systems, DU, LPA, on the front end. And then the loan moves through the process, goes to processing, goes to the underwriter. And the underwriter is really doing a deep dive into all of these different points here. And so what we try and do is we try and be very thorough in reading through this on the front end. So when it gets to the underwriter, there's not a laundry list of conditions that need to be met. Our goal up front is to limit the amount of those conditions. So
conditions mean documentation, a pay stub, a W-2, a bank statement, missing page of a bank statement.
Right. It's like, we will issue this loan when the following things get satisfied, when the following conditions are validated or
in hand and reviewed and cleared. Yep.
Right. The underwriter will give a conditional approval, and like Bill said, that means, hey, this loan is good to go as soon as we have the following documentation. So like I said, on the front end, we're really trying to get through, read through DU, make sure we have all the right correct documentation, so that once it gets to the underwriter, that's a quick, smooth process. So then what it does, so again, it's going through the credit looking at everything on the credit report, it notes that there's a collection. I had a conversation with the borrower. It's a medical collection. Depending on the type of collection and the amount, sometimes it needs to be paid off before closing. Sometimes it doesn't. It really depends. And if you look at line 13, it says the following collection and charge-off accounts are shown on the credit report. And then it says these accounts do not need to be paid off prior to or at closing. So because, and typically with a medical collection, conventional loans can be, very lenient with those. And I don't think I've ever seen one that had to be paid off. Have you, Kathy?
No, medical collections are kind of irrelevant to even the credit score this day and time. It really doesn't hurt them.
Yeah. So that's what we're looking to see, if it was an FHA loan and it was a collection account on a credit card or a car payment or something like that, it might want the borrower to have that paid off. So it's just, those are the different things that we're looking for there. And now we're getting into income. And so in our loan application, there's a box that we can check, that when the borrower fills it out, can check self-employed or not. If that self-employed box is checked, then it's going to ask for different documentation than if it wasn't checked, like in this situation. And in this borrower situation, she's a W-2 hourly employee. And so it's going to tell us what we need. It's going to say, document income using a pay stub and W-2 from the prior year, or a verification of employment. And that's requested from the HR department of that employer. And a pay stub must be dated no earlier than 30 days prior to the initial loan application. So the most recent 30 days of pay stubs as well. And sometimes it asks for 1 year of W-2s. Sometimes it asks for 2 years of W-2s. Again, if they're self-employed, it's going to ask for tax returns, business returns potentially. And so we're looking through this and kind of figuring out what needs to be gathered from the borrower. And a lot of this is, it's kind of worded as, if the borrower, is self-employed, we need this. If the borrower, it needs tax returns, then this page needs to be signed. So it's a lot. We have to know a lot about the borrower and ask questions to make sure that additional information isn't needed. But going through this line by line, does give us a really, really clear idea of what the borrower will need to give us.
I just want to make a quick point here. This is a bit off topic, but you guys have a team behind the scenes that's kind of processing all this information, right?
Correct. Yeah.
Okay, so you're not spending all day long. I mean, you're looking at this stuff to determine, hey, is this a candidate that's actually going to get a loan, right? You need to give great information to your real estate partner to let them know the viability of this. But you're doing a lot of this on the front end. But once you kind of essentially create the list of the topics or the things that need to be satisfied, you essentially are moving on to the next candidate, right?
No, so we're there the whole process. We're there from start to finish. Our goal, again, is to be very thorough in going through, the credit report and DU and LPA, so that if there is an issue, we're catching it up front. In this case, the bankruptcy had to be addressed. The collection account needed to be addressed. We don't want that file a week and a half, 2 weeks in getting to underwriting, and all of a sudden all these red flags be going off. We would rather validate all of that information up front, have all the documentation we need, so that when it does get to underwriting, it's a smooth process.
Yeah, it's a stage you go through. So last night I had a couple that they didn't know if they were ready yet. They wanted to meet in person. So we met in person at 5:30 last night. I sat down and asked about their employment, credit score, debt, and ran some just numbers without pulling their credit in. So that's a pre-qualification. They weren't ready yet. It's a VA loan and there's some things that they have to work on. So there's no reason for us to pull the credit. They need to do a few things before we do. And then once they're ready, once they do everything I told them to do, then we're going to pull the credit and we're going to have a pre-qualification conversation. We're going to have the credit report. We're going to have the income put in the system. We're going to have the assets they have in the system, debt to income ratio, everything you see. We're going to run this system and it's going to go, yeah, great. Ratios look good. Assets are good enough. You know, rates in there, everything's done, the principal and interest, the proposed property, where again, it's a fictitious property. Most of the times they haven't found one yet. If they've seen one they like, I'll go, you know what, give me that. We'll pull real taxes, you know, or put a real sales price, offer price in. Nowadays, of course, if it's listed at a certain amount, I'm like, well, you're going to have to go above that. So let's like push it up a little bit, unfortunately. But then that's pre-qualification. At that stage, then we say, okay, we're going to send you a secure link and a document list. We're going by this. We've got DU saying, get a pay stub, 30 days of pay stub, get 2 years of W-2s, get, you know, bank statements, all pages, you know, get documentation around Social Security income, whatever it is. We get that in hand and our team up front is validating that, looking at everything. Are there any concerns? Does it all match? So now they're pre-approved. Now we can tell the agent, we've done enough, whether it's get with the underwriter up front, look at this documentation and validate it. You don't need a financing contingency. We're good if that's what they want to do. If it's a 20% down conventional and they're ready to make an offer, we put the property address in. That's when we run the system again to see if there's enough comps to waive that appraisal. So it's a full process that you're talking hours of time to do it the right way, to know what they need. We actually have a 40X goal of 100 million for the team this year. Part of that goal is every Friday, we look at the loans that were underwritten that week. We go over them and we see what the underwriter asked for. And as a team, we go, okay, what did we miss? What else could we have asked for to not have any conditions from the underwriter, because we got it all up front. And we do that every Friday just to get better at doing this, at looking at this and pre-thinking what an underwriter needs.
Fantastic. Alec, there are a couple of questions in chat. One is, how are short sales treated? What is the length of time that needs to pass before they can qualify for a loan?
You know, we have a cheat sheet that does all the, you know, bankruptcy, short sales, foreclosures. Kathy, do you know the?
Yeah, most of it you're going to see on most programs. I think FHA is 2 years, conventional's 4 years. I think VA is 2 years. Jumbo is, I think, 4 to 7 years. We'll send y'all that sheet, but we actually have a flyer that we've given to the team before, and it'll tell you every bit of that. So it tells you exactly how many years out of foreclosure, how many years out of a Chapter 7 bankruptcy. We'll get that to you.
Yeah.
And as a loan officer for almost 39 years of doing it, I'll look at that sheet every time I ask that question, because again, it's a lot of information with all the loans on which one is what and what we do.
Wow.
But we'll get that to you.
Yep.
Thank you. And then the other question is oh, there's two more. If a borrower is a real estate agent, what documents would be required? And if an borrower is hourly paid and recently has a reduction in hours, how does that impact pre-qualification?
Yeah, so, you know, real estate agents are treated as self-employed. And so we're going to need a 2-year history of tax returns and 1099s to document that income. So that, I mean, at the end of the day, that's what we're going to need.
What about the smart loans?
Say that again.
What about the smart loans?
Smart series, the self-employed.
Bank statement, self-employed. So we can do either a 12 or 24 month average of business bank statement income. But I believe, Kathy, still you have to have self-employed. You still have to be self-employed.
Any self-employed person, even real estate agent, you're 1099, self-employed, Schedule C, whatever combination, you have to have 2 years license as a real estate agent. So if you're 2 years licensed and you say, you know what, the way I write off my expenses, you know, haven't done 2020 taxes yet, or 2021, we can take, like Alex said, 12 or 24-month bank statements. So the deposits from your income from here, they're going to do a calculation percentage of that income and expenses and use that income. If the tax returns, have more write-offs than, what would allow. We see a lot of meals and entertainment and mileage, and things on tax returns that, of course, your GCI, your gross income starts here, but your income that the government that you say as usable income really drops. And there's a 1099 program. We don't have it yet that Fannie Mae has that we should be getting. And it'll be a really good program for real estate agents also. But again, it's going to be any self-employment loan, they want to see 2 years of self-employment.
And Candace, to your hourly employment question. So it kind of boils down to, we joke, a borrower says they make this much, a loan officer says you make this much, and then the underwriter says you make this much. If you have a decrease in hourly income, the underwriter is going to be, first of all, they're going to know the reason. Why is it? Was it a pay cut? Was it, sometimes there's shift differential that, for what they're going to want to know what the reason is that there was a decrease in hourly income. And if that is going to be sustained for a long period of time, or if that's just going to, if that income did drop for whatever reason, the underwriter is going to take that conservative estimate and they're going to use the lower amount.
Yeah, their employer, their human resource is going to have to say, we guarantee them now the 30 hours a week if that's what they drop to, and they're still a permanent full-time employee.
Yeah.
Yeah, I don't know if this is standard practice, but I remember when I was doing my loan with you recently, I had my CPA created the tax return, and before I filed it, I showed it to Kathy and said, will this get me what I want? Right. And if it was going to get me what I want, then I could, I said, could I take more deductions and still get what I want? Right. So it was, I was almost doing it in reverse because I knew I wanted to have a transaction, right? I need to obtain the financing. And so, yeah, I probably didn't maximize all of my deductions, but that wasn't my priority. My priority was getting a certain amount of money from a loan perspective.
Right. And this is the key, y'all. We'll be glad before tax returns are filed to look at that and analyze it. The CPA and what they do to IRS and the deductions and the income they have and the criteria they have is completely different from what a mortgage underwriter looks at. So sometimes it may not even cost a person much more at all in federal taxes to pay, but if they put more depreciation in, less meals and entertainment, do the numbers in different buckets, then they're going to get more net income that we can use. So we do tell self-employed, hey, if you haven't filed 2021 yet, and I just had a remodeler, and I said, show me what you're going to file. We need to drop 2019 because your income was so low back then. We need you to file 2021, but before you file it, let me just look at it and let's see if there's any areas that you can not take as many deductions with the IRS so that we do have enough income to put you in that price range that you want to be in. And we did that, and his accountant changed a few things. It didn't cost him. Actually, he still got money back because of his wife's W-2 income. But it got him up to a level and a sales price, that now he's looking in the range that he wants to.
Yeah, and a good CPA, if you say, hey, I'm trying to buy a house, they'll know what that means and make sure not to write off every bit of your income. So a couple more things. I know,
just so we know, it's not malicious. It's actually the opposite of malicious.
Right.
You're trying to pay the government more money.
Right.
Right.
Yeah. All right. And just a couple more things here, Bill. And I know we're coming up on 9:15, and I'll leave a little bit of time if there are any more questions. But on the asset side, so it's telling us, hey, the borrower kind of line itemed their different bank accounts and what they make, or what are in them and what amounts are in them, and it's saying, hey, verify assets totaling $232,000, and the line below says the documents needed to support that are 2 months of bank statements. So we need the most recent 2 months of bank statements for every account that they plan on using money from for down payment closing costs. And then, Bill, you were mentioning a little bit earlier about the appraisal. On a conventional loan, when you're putting 20% down or more, there's an opportunity for an appraisal waiver. In this case, she put 50% down, and we did not get the waiver. And so right now in this market, what that probably means is it's priced too, or not priced too high, but it's
It could be. It
potentially it's priced too high.
It could be not enough comps.
Yeah, not enough comps, and that's what it's doing. So it's taking the address that we've entered, and it's comparing it to comps that have sold in the area in the last 2 months or so, and it's saying, hey, based on the comps that we've pulled, the offer price that you plan on making is either justified or not. And so potentially what it's saying, hey, it's whatever you're offering is higher than what we can justify, per the comps that have been pulled in. Does that make sense?
Yeah, what we've done before on the weekend, y'all, is an agent will call and say, look, this is the offer price. Can we get a waiver? And we'll put that in, and like, okay, if we go 5,000 above that, can you still get a waiver? We can run it at any sales price, up or down, and play with the system to see if it'll take it at certain prices. So when you're in that multiple offers, it's going to give you, hey, if you go up above this price, you're not going to get an appraisal waiver. But if you can stay at this price, you're going to get the appraisal waiver, and we can do that.
And I
would explain it the inverse of that, which is you don't want your client to think that having a requirement of an appraisal is a hint that you might be overpaying for the home.
Exactly.
Right.
Yeah. It's just the comps weren't there, and we tell them that.
Yeah.
It doesn't mean it's too high. It just means that maybe this subdivision, doesn't have enough comps for the system to pull it.
I don't even think I'd have that conversation. I'd say, let me see if I can arrange with the lender to have an appraisal waiver, which would allow us to not have an appraisal contingency, and leave it at that. And then
Well, I'm
do all
just
my
saying, if
homework.
we don't get it, and we're with that client, we're talking to them on the phone, and they're like, well, why don't you get it? And I'm like, you know what? There's a lot of comps out there that sometimes it's just slow. It's not in the system yet. Right now, the system is not pulling enough comps, and because it's not, it's not pulling enough comps. They're not there, and we push them back to you guys. Going, you can talk to your agent about it, but we can't waive it.
No, I wouldn't. I would do something a little different.
Okay.
I wouldn't do that at all.
Okay.
So I don't want to have to explain why there is or not enough comps. The reason why you need an appraisal is because you are bringing 20% or less than 20%, and the lender is taking 4 to 5 times the amount of risk that you are, and so they want to do a little research. End of story. There's nothing else.
Well, this is 50% down, still didn't get it.
Well, yeah, but theoretically, they shouldn't even know they could have it. So everything that you're offering is a potential bonus. I don't think the borrower is going to say, I'm going 50% down. Why can't I get an appraisal waiver? They don't even know what an appraisal waiver is.
Well, actually, we discuss it. So because of this market, one of the things that is a big discussion is, can we go in with every file? Can we go in with no financing and no appraisal? Every agent asks us that question. So we have to address it up front.
Okay.
Well, how can you waive that appraisal? Well, the system might or might not waive it. But we do say, you know what? Unfortunately, 95% of the time, it doesn't waive it.
Okay, that's the important part.
That's the important part to make. 95% of the time, even with 20% down, it doesn't waive it. It's not reading enough information. We could drop the word comparables. It's not reading enough information on the property with the combination of everything in the loan to waive it.
Yep.
That it is true. 95% of the time it doesn't.
Yeah, I had one this weekend that was it waived it at the offer price, but didn't waive it at the escalation price, which was only 10,000 higher. So like Kathy said, doing that on the weekend and kind of saying, hey, if you can get it at the offer price, we're good. But if you end up at the higher escalated price, then you're not going to have it.
That appraisal gap.
Yep.
I hope what everybody is getting from this is how crucial our partnership with our lenders are, and how important it is to have the conversation before you write an offer, so that you do the best for your client that you can do, and also make it one that works.
Yeah, having this desktop underwriting, having that worksheet on that specific home, running this, like Alex said in the beginning, with the taxes, estimate on homeowners insurance, the HOA, and we do have to pull 2021 taxes. I know most of y'all see 2020 on most of these listings. We have to pull 2021, make sure we know the city and county. We put all the information in to make sure that they're okay, but put the property address and also if it's 20% down to see if this can be done. So then your offers going in potentially no financing, no appraisal contingency, closing in 15 days. It can be a very strong offer on a conventional loan with 20% down.
Why, Kathy, in your opinion, why is it important for a real estate agent to even be familiar with this stuff?
You've got to understand your buyers are really overwhelmed with most of this process. You know, we're having deep conversations with them. A lot of lenders aren't. And even though we are, it's a lot of information. So you can't go by what they tell you. You can't go by, they said, the lender, we can do this or that. You need that relationship with that loan officer to truly know what you've got. If you put this in without a financing contingency and that lender hasn't done enough due diligence, you can learn, they could lose their earnest money. You know, another situation we talked about the other day that I was mentioned today, you know, if there's a creek, if there's any water close to a house, during due diligence, the lender needs to tell you if there's any flood insurance required. Really, if there's a flood insurance required on any house now, the flood maps have changed. It's very expensive. During due diligence, ask that lender, has your company run the flood on this house? If not, I need you to do that before due diligence is over. And as a buyer's agent, take ownership with that. If you're a listing agent and there's water, creek, or whatever, of course, you ask the seller if they have ever had to have flood insurance. Again, maps keep changing. You want to get a flood pulled by an insurance agent to see if the house isn't a flood. It's just a good, you know, process even for the listing agent because of the flood maps changing.
Right. And I've always said that your job as a real estate agent is essentially to make sure that everyone else is doing their jobs.
Right.
Right. And so don't think, oh, that's the lender, they'll deal with it. Oh, well, I asked for the HOA information and it's really the seller who's supposed to do it and I'm on the buyer side. Look, if it doesn't get done, you're not going to get paid. Right. So as I've said before, if you find yourself doing your job and most of somebody else's job, congratulations, you're the best agent in the transaction and you just got to keep it up. Okay, what other questions do we have? All right, Alec, you must have been just phenomenal, sir. Thank you. Thank you. No other questions, huh? Okay, can you just speak for a quick moment on credit repair and how do you handle that?
All right, Bill, it sounded like someone popped in and maybe had one question there.
Yeah, I had one. Yeah, one quick question. Generally, when we have a referral to pass on, what format do you want that in? I know I spoke with Alec yesterday. He said send the phone number and email, but is there anything else that I need to brief my buyer or client on? So when they call you, they have X, Y, and Z immediately?
No, so that whatever way you guys are comfortable sending referrals over to us, we're good with. If it's connecting us in a text, email, doing a three-way phone call, I think it maybe depends on the loan officer. I know with our team, we say whatever way you guys are most comfortable with, we're able to accommodate. So, but in terms of
ask your buyer what they want. I mean, do they want a pre-qualification before they fill out the application? Do they want to talk to us and get a general overview? Do they want to do that with you on the phone, you in person here at the office? Ask them. And like Alex said, it's how you want to handle it. We get joint text with both people on the text. We get emails with them connected to email. And sometimes we just get a phone call and say, hey, Lorinda said to call. So it's really how you want to run your business. Giving us insight up front as much as you can before we do a pre-qualification is great. But if you're on the run on a Saturday, all of a sudden you've got someone that thought they were just going to kind of kick around some properties with you, and then they find that perfect home, and we need to do that online application right then, over the phone right then, just let us know. I mean, whatever you need.
I think this is a great opportunity for the partners to as Andy likes to say, give me a great reputation to live up to.
Yeah.
Right. So I would say, hey, Joe, meet Kathy. Kathy's been in the business forever. She's very patient and thorough, and she loves teaching people how to secure the best financing possible. Kathy, meet Joe. Joe and I went to college together. Him and his wife are a lot of fun. They're looking for a home in Alpharetta, something like that. Right. So everyone gets complimented, and then everyone now can reach each other.
If you send it by email or when we do send the email link, we're going to have you on that, and we're going to thank you for the introduction. And in that email, it's going to say, Lorinda's amazing. Linda and her team, we always say team, is amazing to work with. We look forward to helping her get you your dream home. And that's in our email follow-up. So just know we're trying to build you up and connect you to them stronger through the whole process.
Great job. There's a question about the ideal ratios. I guess the ideal ratio is the front end and the back end to be perfectly the same, right? Where somebody has no debt.
Yeah, it also, it depends on the loan. There are a lot of factors that go into if we get that approved eligible. For a conventional loan, someone with a lower credit score, it might only take up to 43%, and someone with a higher credit score, it might go higher. So, ideally the lower the better, but we just have to, it considers a handful of different factors. So we just have to have all the information in there, run DU and see what it'll take.
So
if you read through the suggested number is 33% of your gross income for housing. And then your debt above that, another 10% if you add your car, credit card, student loans. That's kind of the numbers that are out there. But like Alex said, it really depends on the combination of credit score, down payment, reserves. Sometimes if we throw in a 401k and they've got 20,000 in there, it'll let the debt to income ratio go a little higher. So this underwriting systems, they're reading everything. Like it's reading, how much credit do they have? The gentleman and the lady that I met with last night, they have paid cash for everything for the last 7 years because they did get in trouble back then. They opened credit cards back in September or October. So it's going to be questionable if I don't get at least 6 months of credit history. We may not, in our scoring system for mortgages, we may not even get a credit score. So really,
does that mean they can't get a loan?
On a VA, possibly if they've got 6 months of history and we get a credit score, and I can do manual on the fact that they've paid rent on time by check for 4 years, they paid utilities on time, they paid cell phone on time, and build a credit profile, we possibly will get an automated underwriting or a manual underwriting, they'll be okay. So we're waiting to make sure they've got 6 months of payments toward their credit cards. They have valid credit scores and Credit Karma that are popping up, and then we're going to try it.
Yeah. I think there's a responsible debt and irresponsible debt. And I think it's our jobs, not necessarily as realtors, but just as people trying to live in society, that you should, constantly be learning more about how money works and, how things that are more risky and dangerous than other things.
Yeah, it kills us when we get an application and they go out and buy a car, right before they apply for the mortgage, and it's like now you see a $700, $1,000 car payment, and we're like, well, I'm so sorry,
Hopefully
but
they make like 800 grand a year.
Usually not. And then we have to tell them, because you've got that car debt, now you can't even get close to what you want to be, and it just kills me. So anything you can do with family, friends, everyone you talk to, don't go get a car payment before you buy a house. Get the house first.
Yep.
Get the house first. Don't even let them pull new credit cards, new car payments. Just get that message out there. It can really tank their scores, and just adding that little debt sometimes pushes them out of the price range they need to be in.
That's right. All right, any final thoughts? Okay, Kathy, Alec, and the rest of the team are, in my opinion, go way, 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 way above the typical expectation of a lender partner. I want to just thank you for that.
Thank you.
Give them a try if you've not worked with them directly. I highly encourage that you support their businesses just like they support yours. And they're available to learn more about these loan products. They can go into further detail with any of these kind of sheets and make sure that you feel comfortable, kind of having a basic awareness about how the underwriting and financing processes work. All right.
Mortgage A through Z class.
Okay, when is that?
We're gonna look at the calendar in March and try to keep it every month. But if you guys can't make that class, schedule time with Alec or myself. We could do a semi, private class or individual class, Zoom with y'all and go over it. But the mortgage A through Z class, it used to be a CE, and I just took it into a class that's about an hour and a half. We go through everything. You'll know more about mortgages than some loan officers do.
Okay, beautiful.
When is that class?
We're going to put it on the schedule in March. And again, we're going to get with the staff to do that. We were looking at the calendar yesterday and trying to fit it in. We do have the March 3rd disc profile class coming up, and we're going to try to fit it in maybe mid-March. But again, if that date doesn't work for you, once we get it on the calendar, reach out to Alec, reach out to me, and we'll schedule time to do it with you. Happy to do that one-on-one.
That's awesome. Thank you.
All right. And if there's something, I'm going to address you directly, Kathy, but please know this is for everybody. If you've got a question or you want to ask something in private or something's unclear, don't wait till the event shows up on the office calendar. March right in here and knock on Kathy's door and say, I want to know something.
Right.
Answer my question.
Text or call. Yeah, text or reach out to us. And if we don't know it off the top of our heads, we'll find out for you and be happy to do that. And I always say all lenders are not even. If you hear from a buyer and it just doesn't sound right, what their lender told them, sometimes a second opinion will work because the lender's just not maybe experienced enough or taking enough time to really look at what might work for that client. Again, just know, we're here as your mortgage experts. That's what we want to be. Any questions around the mortgage industry, reach out.
That sound familiar, right? Any questions around the real estate industry? I want to be the one you call.
Yeah.
Same concept, right? All right, y'all have a wonderful day. Don't forget, Build a Rockstar Team with Ray Wayne is today from 1 to 4 and Thursday from 1 to 4. And those links are available. Registration, but it's free. You can find in the daily newsletter. You guys have an awesome day.
You too.
Thanks, Kathy.
Thank you.
Thanks, Alex. Thanks, Bill. Bye.
Bye.